Can you all hear me okay? Okay. Thank you.
Yeah.
All right. So let me walk over here just a second. So sorry, I'm just making sure everybody can hear. So what we're going to do here is we've got some questions in terms of, what this first week is, or this first question is. So we're going to be looking at working with a statement of cash flows. So given the information in the pop-up window, prepare a statement of cash flows. So we went through this a little bit. Sorry, it just says my audio is not good. Well, yeah. So we can use this pop-up window, and this is going to give us our information for, okay. All right, good. Our cash flow. So what are we going to need to go through and figure out our cash flows? So this, you're going to follow along with like what's in the textbook, what was presented in the PowerPoint. You can come up and you can start to see what pieces need to go in there. So the first thing we need to figure out is, and you guys are going to have to help me with this because I'm not just going to do it, but what's the first step one that we need to figure out? Anybody know what we need to find first for the statement of cash flows?
Would it be net income?
It is net income, Kennedy. So how do we go about figuring out our net income? Because it's not in here, but everything that is in here would be on the income statement. Okay. So when we look at the items that are in here, we need to be able to look at, while we're doing this, we can have our income statement, our balance sheet up. Okay. Because that's what we utilize to create the cash flow statement. But to find net income, when we think about the things that are on the income statement, it's operating income, it's interest expense, and it is income tax. Depreciation expense can go on there, but it's not part of that right now. We'll do some adjustments with that later. So what we need to do is it's going to be a drop down here, net income, and we need to take our total, that is what, 74 minus the income tax and minus our interest expense, which is here. So 74 minus 26 minus 16. Okay. So that's going to give us $32 to start with, right? Now, what sort of adjustments do we make in terms of the cash flow statement? What are some options that are listed on here? When we talked about inflows and outflows, all that fun stuff about how do we figure those pieces out? Because we talked about as money comes in, like accounts payable. I'll give you that one. So we see an increase in accounts payable. So that means even though we borrowed money from a cash flow perspective, they came in. So we can what else is a positive cash flow? Do we want to do this today? I would suggest you open your textbooks or the PowerPoint so we can get through this, because the next problem takes about 30 minutes to go through. So it's a pretty heavy one in terms of figuring out. You have to build the common size balance sheet, common size income statement, a cash flow statement off of it. So when we do these problems, I'm not going to do them for you. So you had, I guess, look in the book.
What was your question? Because it's kind of lagging.
What are the adjustments that need to be made in here?
Is increase in inventory the next one?
Yes. Now, is that a positive or a negative, Mac?
Positive?
Now, if we increase inventory, that means we would have had, from a cash flow perspective, what we would.
Oh, it's negative.
There you go. Okay, so negative 32. So now again, these are all listed as positives, but in terms of when we attach them to the cash flow statement, if we spend money, that's a negative. So an increase in inventory would be negative. Now, even for accounts payable, we borrowed that money, but cash flow came in. So it's 23. So what else do we have?
Increase in account receivable.
And is that going to be a positive or a negative?
Is that positive?
Negative.
So we made more sales, but we didn't collect the money.
Negative.
It's going to be a negative on this one. Okay, so I'll probably list it here. All right, we got one more. The one that's the strangest one, I think I said this the other day, depreciation, which never really enters or exits the books except for on the cash flow statement. So I'll give you this one. Okay. So what we do in terms of that is now we take net income and we add this minus that, add that. So when you do that, and you can do this in Excel if you want to, but this is going to be the first step. Okay. So when we look at that, we see that it's done. Okay. So we got the net cash provided by our operating activities. That's step one. So next we move into cash flows from investing activities. Now it's the same drop down. So we can automatically eliminate depreciation, AP, and net income. So if we were thinking about investing activities, not financing, but investing activities, what might that fall under? Which one of these would it be?
Increase in gross fixed assets.
Yes. And the other two, and that's good. And the other two are related to financing activities. So dividends and common stock are our financing activities that are attached to common equity or common stock and dividends. Okay. So this one is increase in gross fixed assets. And that means we probably bought some equipment or a plant or building or something like that. So if we bought something, that means this number here should be
Negative.
okay. And then we go ahead and put negative 36 here because there's only one activity. Now, some of them might have more robust things in there. Uh-oh. So it's not, it's a 23. Cash. Oops. I came up with 36. Why is it telling me to do that? Can't add depreciation in here. There's not another box. Just a sec. Let me pop this off here real quick. Sorry. I'm not sure why it's asking me for another box. And I see what it is. Okay. You wanted us to preemptively add those. All right. My fault. So it wants us to add increasing gross fixed assets. So it is the depreciation expense and the net fixed assets. So we're going to go negative 36. There we go. Okay. So it was the depreciation plus. You just had to preemptively add it. It didn't allow you to drop down the other one. Okay. Let's see. That leaves us for our financing activities. That leaves us what I said about dividends. We'll do common stock first and then dividends get paid out afterwards. Increase in common stock. That means we sold equity. So that would be in terms of cash flow, we would have collected the cash. So increase in common stock is 19. Dividends would be an outlay of 14. And so the difference there would go in here. So now what we have is these three outliers here where they've done the deductions. What we actually see here in terms of cash flow, what do we see? Negative 36. We add 12 back to that. So negative 24, we add 5 more. And we see that our decrease in cash is 19. Okay. So if we go back to this just real quick, I'll reset it, of course. Let me show you on a different screen here. So this is a way to work it out in Excel. If we look at this here, this is basically the pop-up that we had. And everybody can see this, right?
Yeah.
So I put everything down and then I said, step one, find net income. So what I did is I just operating expense or operating income minus interest expense minus income tax. Then I had our adjustments laid out and listed them exactly how they were here, but then figured out whether they were positive or negative. So depreciation was positive. We saw an increase in accounts receivable, which means we've had some sales, but we didn't collect cash. And then increase in inventory. So that's a positive in terms of our assets on our balance sheet. But to do that, we would have had cash outlays in order to obtain that inventory. And then accounts payable is us owing a vendor or owing somebody money, or we borrowed money, but we haven't paid it out yet. So we kind of use that as a balance. So that gives us, in terms of operational activities, $12 of cash flow, or if it's in the millions, whatever it might be. This one was essentially equals net plus the depreciation expense, but I needed to make it negative. So just negative. Since it's an outlay. So we would have bought something, some sort of fixed asset, and that's a cash outlay. In terms of increase in common stock, that would have been us selling equity, so that had been cash in. Our dividends always paid out. Here's the variance. And then what we see here is this plus this plus this. And that gives us our starting point. Okay. Questions on that one? You'll have a couple like that. In terms of trying to figure out the cash flow statement. So it'll be attached to like this question as well. Like you'll do a statement of cash flows. So it'll have a similar layout. It might be functionally a little different. But for the most part, it should be very similar in that regard. Okay. So in terms of the next one, how much is the firm's net working capital and what is the debt ratio? And we'll get a little more time next week on debt ratios. But does anybody recall what the net working capital formula is? Pop these up here.
Current assets minus current liabilities.
Yes. So we see, and we're going to use 2018 to start. Okay. When we get to the cash flows, we'll have to bounce back into 2017. So this problem takes quite a bit of time to get through. Okay. So if we're looking at current assets minus current liabilities, we see current assets here of 1192. And then we deduct out our current liabilities of 295. Okay, so if we do 1192 minus 295, we get 897. Okay, and then it's going to say, what is the debt ratio? And the debt ratio, we're getting introduced to it a little bit early, but this is a pretty straightforward formula. Think about our debt. How would we measure our debt ratio? So it's going to come out as a percentage.
Total liabilities over total assets.
Yes. All right. So what do we see as, we have our total assets right here, right? 617. And our current liabilities are here. And then this is our other debt exposure. So we would have 895 over 2,617. So it gives us what I think is 34.2. Okay. So here's where it gets a little more convoluted. Okay. And this is where I would move us. Let's see if I can get this out of the way. Sales. So we've got a couple of options here. We can, I would encourage you to do this in Excel and build it out and make sure that you're good to go in terms of the formulas just being generally right. And if you do this, if you do it the way I'm about to show you how to do it, you'll be able to just replicate this anytime a question like this pops up. Okay, so what I'm going to start with, let me just pull over a couple of items here. Update them. 615, P&E 2631, 6, 1425, AP. Okay. So I'm going to move over here and I'm just going to show you first the common size income statement. Okay. So this is really where we're at. So we started here where we needed to figure out, the first question was our working capital. So we took in what our current assets were. So you see that over here. And then we took out our current liabilities, which you see here. So basically I took these couple of pieces and I just put them into Excel. You can do it by calculator if you want, but this is a much faster way. So I replicated all of these pieces, sales, COGS, selling and general and admin, and we see that net income is the same, right? We see that that's 185, so we're good here. And then if I scoot over here, we see at the bottom 2617. We see that for total assets on the balance sheet. It's got a balance. Okay. So common size, we're just figuring out in terms of the income statement, how much of each of these items is in comparison to sales. Okay. So obviously sales is going to be 100%. So I wrote the formula of this cell and to start divided by this cell, and then I locked it with the dollar signs. What that allowed me to do is if I just delete all this, now that I have this locked, right? Let me just drag it down one and show you how it's different. Now we see as I drag it down, the blue one moved here. And as I drag it all the way down, it'll do the work. And if you lock that cell with those dollar signs, you can hit F4 and it'll do it. It'll lock this. And then you just have to do, it wants to go a little bit further. Do that. Then you just drag it down and it gives you the common size. Okay. So this is why we want to be able to use Excel. And so as we see here, then we just go through and we just input, you know, I'll type these in real quick. 58.2.
You just took the first cell and divided it by itself to lock it in.
Yeah.
Okay, cool. Thank you.
I think I missed this one. Just a second. So this one's supposed to be 14. All right, I messed those two up. So what I messed up here is when I did drag that down. Here originally it was tagging these cells. So these two, since they're off to the side, I did need to adjust those. So if you'll see, they'll change here in just a second. So I had the wrong cells. So that can mess you up. But if you just grab them and you just make sure that you're doing depreciation total, that will work. Okay. So next, what we have is the common size balance sheet. So I'm gonna lower this. And that's what we have here. So again, we see it listed just like it is here. All right, total assets all the way down. And so if we do that same exact thing and just scoot over a bit, we have our common size balance sheet again, exactly how it's laid out right here. Okay, so all I did was match it up and then I input the data and everything aligns exactly how it is over here. Same process. Except what we're doing is against total assets instead of revenues. Okay, so we take the observation divided by the total. Okay. We do the same exact thing with the common size balance sheet. I copied it directly over as well. In terms of the liabilities here. So let me pull this over here. So now we have our common size liabilities. We have accounts payable, notes payable, current liabilities, bonds, owner's equity, common stock, all. Now it's attached to, again, the 2018. All right, so everything you see matches exactly what they provided us. And it's the same as the prior one. Where we take the observation divided by the total. So it's the same as above when we were in the asset section. And you just lock that cell in and you just drag it down and then it'll input there, okay? So let me pop these two in real quick in terms of the answers so that we can move to the next question. So cash is 6. And then let me pop in the balance sheet. Again, all I did was copy everything over and it bounced in. Okay. So now we've utilized the tables that we needed for the most part. This one's going to have to come back up in just a second. Okay, so now we're back to that similar question that we had in part 1. Okay. And so what we can do here is we have to figure out the same thing. I'm going to try to move around a little bit. So I went ahead and moved the balance sheet over. I'll go ahead and get rid of that since it's over here. But again, to figure out our net income, I made it equals right over here. What we had already figured out, right? We had taken the steps earlier to figure out, based on the common size income statement that was provided, we were given the net income in the right here, 185 on the income statement. So again, I'm just using Excel, but regardless, you start the same way we did with this first question. Step 1, find net income. Step 2, figure out your adjustments, okay? So the way I laid it out was balance sheet right here. We have to figure out if we had an increase or decrease in certain pieces. So I got the net income from our income statement, right? And I also need to get the depreciation from there, okay? So we had 206 in depreciation, okay? So those are from the income statement, and these pieces are part of the balance statement, okay? So let's look at how do we determine whether we have an increase or a decrease in AR? So our AR went from 450 to 421, okay? And I find that right here. So I took 2017's information and I minused the 421 out. So we see a variance of $29. And if AR went up, it should be a negative, right? Inventory, we see here, went from 550 to 615. So it's 65. And then a decrease or increase in accounts payable, we see a decrease of 41. Okay. So far, maybe put those numbers in and see if we're on pace. Because that's this, as again, it's the same thing we did on the first question. Oops. Depreciation is 206. Where's my depreciation? redoing the math here, make sure we're right. This is where I messed up. It is a decrease in AR from 450 to 421. So we actually saw an increase in that because that would have been cash received. Increase in inventory was expense, decrease in that. And so that was my mistake on the AR. Okay, increase in plant and equipment. So we see that we had an increase in new plant and equipment from 1,200 to 1,425. So make sure that's all good. So that's going to be an outflow of or 31. I apologize. So what it is right here, not the net. Okay, so 431. So we went from 2,200 to 2,631. Okay. And now we have to go to the financing activities. So we see increase in notes payable or a decrease in notes payable. We see an increase in notes payable of 136. And then we have to figure out the dividend, which is going to be an outflow. And how do we determine dividend? Anybody remember this?
Can you repeat the question again? It keeps spacing out.
I apologize. It's the how do we determine our dividend payout?
Dividends over income.
They come out of net income or retained earnings. Yes. So we would pay it out of our net income to start. So if you recall, our net income was 185. And then we move out of our retained earnings as well. So our net income is added to retained earnings. So while our net income was 185, we see that we actually only saw an increase in retained earnings of 122. So that means our dividends were 63. So whatever we don't spend out of net income always goes into retained earnings, and retained earnings is the cash flow that the company has kept on hand during the life cycle that it's had. Okay, so we've got that one, and then we just need to do the variance here and the net decrease or increase in cash. And that is putting these all together. 314, 431, and 73. So when I do that, it comes out to negative $44. We are done with that piece. So what was our cash on hand in at the beginning or whenever this file was made? So our cash on hand in February of 2018 was 200, and our remaining cash is 156. Okay, and that's the variance between these two. Okay, so I could go back to that. I'm not sure it's going to save it. It did not, so we're not. So it's saved on the video, but here we'll work through it real quick. We started with all of that information, and I just put it into the file here. So we started with all of these pieces, and we did the common size, and then we built our statement of cash flows, much like we did from the prior question. They're going to be a little bit different in terms of increase in accounts receivable or decrease, etc. But we build it the same exact way. We start with net income. We figure out our adjustments and whether they're positive or negative. And so in these cases, increase, decrease. This one is an increase. And this one was a decrease in accounts payable. Okay, so if we look again up here, and we see increase in AR was negative on this example, but we see that was it actually went down, so it would be a decrease in this one. So you can do some comparative between the two. An increase in inventory for both was met with a negative number. And then this one had an increase in accounts payable, which means we borrowed cash and we got it on hand. This one was a decrease in accounts payable, so we paid back whatever outstanding balances we had. So that's a negative. So you see a little inversion here, but it's the same layout. Net cash, cash flows from investing. We've got to figure this out, and that is the original number that's on the old balance sheet from 2017 to 2018. Some of them are going to, you need to analyze the difference between the years. And that's how we came to this one, this one, this one. And then this is just, we could slide this over here if we wanted to, because it's just the totality of this. Okay. We have about 10 minutes left, and I have one other question here. And so what this question is, and this one always trips students up. So I want you to think about this one. So we're going to calculate federal income tax. Okay. We are given the production has a taxable income of 19.8 million. And so let's go and put that 19.8 instead of 7. This is the other corporate tax rate table. So the first $50,000 is taxed at 15%. So I went over here and I replicated the numbers. And like for this one, I took 10 million minus 75,100. Okay. Anything over 10 million is taxed at 35%. The surcharge here, I used these numbers, 335,000 minus 100,000. So that's what an extra 5% gets tacked on for that range. And then 3%, anything over or between 15 million and 18.3. Okay. So what's interesting about this one is these never change. Okay. They're always going to be that as long as the company made more than $75,000. And I think in all the examples, it does that. So what I did is I just took 15% times 50,000. And I did that here as well. And then I did, since they actually made more, or they made up to 10 million, I just went ahead and did the remainder. So we took 34% divided by this amount of their income. Now, you have to take these out each time. That's why I broke it up this way. If we just did 35% on the flat amount, it's pretty close because it's their average. And this one is unique in what it's asking. Because you're actually going to round up and get a very similar answer. But what we see here is anything over 10 million. Okay, so what I did is I said, all right, well, what's this minus $10 million? Okay, that leaves 9,800,000. And so I just took this 9.8, multiplied it by the 35%. Then the same thing for the 5% surcharge and the 3% surcharge, and then come away with the total. So in terms of the 19.8 million they made, 6.93 was taxable. Okay, so let me let's see, that's this question. This one. So it's corporate income tax. And so what's neat, if you know, not neat, but if you build it out in Excel like this, I can simply put in the 20. Yeah, and it's just going to adjust everything for me. So we can type in that should round to the nearest dollar. Okay, that should be it. Okay, so see, all I did was once you put the formula in and you build it out a little bit, then I can come in here and say, here's another one. Here is the actual one that we were looking at. So they had 19.2 listed here. And then in the pop-up, it says, here's that table I built. And so if we do 19.2, we see that we are going to round up $1, 672. Oop. All right, great. What's the average tax rate? So what was the average tax rate that we paid? How can we figure that out? Any ideas?
Taking the amount that you paid in total in taxes and then dividing it by your total income.
That's right. Okay, so 35%. So if we do that, right, you're 100% right. If we do that, all I did here was I took the payment amount divided by that, and we see that's 35%, which is pretty much what we got when we took the number times 35, right? So it's a trick in the system, but that's the right answer. And then the marginal tax rate is going to be the same. Okay, and that's simply because the marginal at this point, because they made so much money, it didn't really matter. So if we do this again, now they want to say, all right, they made 29.1. Again, everything's fixed itself. We have an immediate answer. I didn't put too many zeros in. Okay. And again, what we're going to see at that high of a level is the same average tax rate for both. Okay. The rest of them are pretty straightforward. Balance sheet. So we would go here, and what goes on the balance sheet? Cash, AR, inventory. We would just build that off of this. Okay. So you enter it, and then you start to build your total assets. So what you can do in terms of this is just look at how the examples laid out in the textbook, so, or the PowerPoint, however you want to do it. And what you do is just input the pieces that go there. So I would do cash first, and it does need to be in a particular order. So don't get sloppy with it. I don't know if it will reject. Let's just see here. AR. Let's do inventory. And then we just add those up. So let's see if it might have it. Let's switch those out. Oh, it's not full yet. Okay, so then you'll go over to your total current assets, and so again, you'll be able to check those on the PowerPoint or the textbook. So those were the three toughest questions that you had. Again, so what I'll do is I'll stop recording here, and then